Today we are going to teach one of the important and considered toughest subject, that is risk management. This is CAB BFM Module B. Many people or many students consider this is one of the toughest subject among all the subjects, but not true. This is not that much toughest, but I can also say this is not that much easy also. If your basics are good, if your concepts are good, then this subject is for you. And if anybody wants to be a specialist officer in risk management or some forex or any other department, this subject helps him, because this is the one of the cream subject in banking industry, because it's not everyone's cup of tea, right? Okay, let us discuss about the chapter. In this chapter I am going to discuss about the basics of risk management, means types of risk, what the bank business doings, what are the banking activities which is associated with the risk. These kind of concepts will be discussed here, and consider this is the basics of the risk management. And I'm sure you, let's start with the definition. What is meant by risk? Simple definition. Don't make it very complex. That is nothing but what? The possibility of loss. The possibility of loss is nothing but risk, right? The possibility of loss. As per the textbook definition, risks are nothing but uncertainties resulting in adverse outcome. Uncertainties resulting adverse outcome, adverse in relation to planned objective or expectation. Suppose you are going to plan one thing. Suppose you are going to a trip. You planned everything, you booked the hotels, you booked the vehicles, and you everything has done. Suddenly something happened, means some pandemics or some cyclones are happen, so the whole plan will be disturbed. That is nothing but risk. The risk is associated with what? Where the risk is environment, because your environment makes you disturb everything, right? That is the risk. In the same way, in the business, every organization make a plan, make a strategy to achieve their goals or to achieve their targets, but there would be some unanticipated incidents that causes the bottleneck of the business, right? That become the bottleneck of the business. That is called risk. Risk is nothing but what? Risk is nothing but it's uncertain. We can't expect what will happen. And adverse in relationship, that unexpected things will be in the negative thing, that unexpected things will affect in a negative way to our business, or in sometimes it will be in a positive way also. Got it? What is finance risk? Finance risk is also nothing but uncertainties resulting adverse variations. Of the same definition for everything. Nothing but in adverse outcome, adverse in relationship. Uncertainties, adverse outcome, adverse relations. Just remember these three words. That is nothing but this. Definitely you may get one question about the risk definition. Just read carefully. And what the properties of the risk? Properties of risk nothing but what? It is uncertainties. In uncertainty is mother of risk. Also uncertainty is associated with risk elements. Uncertainties impact the various net cash flow takes place. Right. Got it? Suppose your business is going good, something happened, so maybe some political disturbance or some pandemic or some environment disturbance are happen, or some government instabilities happen. What is the main impact? The first impact is nothing but net flow, cash flow. What you are going to expect, the cash flow, the cash in, you may not get that much amount. That is the cash flow. Cash flow is nothing but what? The amount you should, the amount you're expected to come, that may disturb. So the whole, if that is the main thing for every business, if that thing is disturbed, automatically the outflow will also be disturbed. That is nothing but, I said that variance in net cash flow takes place. The possible unfavorable impact the risk business, that is I'm telling now, right? And one more point, lower risk leads to lower variability. We all know, if you take the lower risk, the lower variability and lower growth also. And in similar way, higher risk, high return, same, higher ups and downs. Okay. Zero risk, no variations. Got it? And there is a linkage among risk capital, risk, capital and return. And this we all know because everybody usually invest in share market. We all know risk and capital and return, these three are interlinked. Like if there is a risk, there will be capital and there is a return. If you take a high risk, there will be high return. This high return is going to what? Capital. Got it? Again with that capital you will take another high risk and again high return, and that will accumulate to the capital. This is the cycle between these two. Suppose you're an onion trader, right? You are having 1 lakh rupees of capital and you purchased around 50,000 rupees of onions, and suddenly the rate will fall down and it went to 30,000 rupees. Got it? This is uncertainty. Uncertainty happened, and if rate fell down, you got it a loss. You are having another 50,000 rupees. Again you purchased, and suddenly the rate was hiked, and you got it 70,000 rupees. What will happen? If you take the high risk, the high return. If you take the low risk, low return. Similarly, if you take high risk, high return, again the risk is linked to return, the return is linked to capital. Got it? You got the high profit. Where the amount will go? The amount will go to the capital only. With the capital you take another risk. Got it? These three are locked, trinities are like a tripod. These three: risk, return and capital. Okay. Why risks to be managed? That is the most important question. Why risk to be managed? If you don't manage, what will happen? This is the very important question. I will take the example. Then the previous example, you are an onion trader, right? You are having 1 lakh capital. Got it? You are having 1 lakh capital. One person, another person is there, that is your friend. He is also onion trader. He is also having 1 lakh capital. You are good risk manager. The other fellow is not a good risk manager. You purchased only 30,000 rupees of onion, but other fellow has taken whole 1 lakh rupees onion. Because of this greedy, he expected that I will get the high return. Okay, and suddenly the rate fell down. You sold it for 20,000 rupees only. Other fellow, he sold it for 70,000 rupees. And again he needs to purchase, but you don't have a capital. The capital is what? It's a backbone, it's a pushback. You don't have a capital. He is not a good risk manager. He is not managing his risk. That's why his total capital has eroded. But in your case, you purchased only 30,000 rupees. The rest 70,000 are there. So again you can purchase 30,000 rupees. The rate may be fell down or may be high. If it is high, you will get profit. If it is low, you will get the loss. But what one risk manager has to do, he should have one backup plan. Is nothing but a pushback. Here total capital he doesn't invest it, but here total capital he invested. That is the bad risk management. This is the good risk management. Okay, good risk management nothing but what? He has to look after the 360 degrees of his business. That 360 degrees of business he has to manage. Got it? Good. Next. Again, now what is the risks in banking business? Risks in banking business means what? First and foremost thing, we have to understand what banks are really doing, what kind of activities banks are doing. That is the must thing. So I have segregated these. These are if anyone, then take a screenshot about this one. Generally what banks are doing here? The first and foremost, corporate finance, this is the high risk, the retail banking, commercial banking, trade and sales, agency services, payment and settlements, asset management. These are the majority roles banks usually plays. Right? Corporate finance is nothing but what? Merger and acquisitions, underwriting, securitization, research, debt and equity, high risk. Every activity associated with the high risk. The retail banking, generally we usually do that we will give the loans and will take the deposit. This is all comes under retail banking. Commercial banking, project finance, export finance, trade finance, leasing, bill of exchange, these are all comes under commercial banking. Also bank will do trade and sales like foreign exchange. This is also associated with high risk. Prime brokerage, lending and repos. Agency services, agent services is nothing but what banks usually open the demat account and usually sells the shares, mutual funds, depository receipts, all comes under agent service. In payments and settlements, bank usually gives the payment gateways to many other organizations, right? Fund transfers, clearing and settlements. And last, asset management. Every bank is nowadays is a own mutual fund, like they will pool the amount and invest into the share market. This is the asset management. These are all banks activities. Generally these are the activities of every bank, every financial institution, right? So we can absolutely we can say every activity is associated with some kind of some magnitude of risk, right? Some may low risk, some may high risk. Got it? These activities are associated with the risk. We as a banker, we as a risk manager has to manage the risk, and what our duty has to earn a profit to our organization. As a banker, as a risk manager, this is our prime duty. Got it? Now we have to learn the broad areas of what banking doing. Actually these are the types of activities. All these types of activities can be grouped into your three activities. That is, one is the banking book, trading book, off-sheet balance exposure. Simple. These are the activities I have just grouped into your three activities: banking, trading, and off-sheet balance exposure. What is meant by banking book? Banking book nothing but our daily banking. What we are seeing and what we are doing in our branches is nothing but banking book. Nothing but assets and liabilities. Here you can get the assets and liabilities. We will get the deposits considered as a liabilities, and we will give that loan considered as the assets. Right? All advances, deposits, and borrowings is nothing but is all comes under banking book. Normally these are held till maturity. Suppose you have given one loan that is for 5 years, for 7 years. So majority case they will be closed at 5 years or 7 years. Some may do the premature. That is the separate case. But majority cases they will those assets or liabilities will be up to the maturity date. And accrual system of accounting. What is meant by accrual system of accounting? We all learn about in this system of accounting in JIB. What is accrual system of accounting? In this type of accounting, first we will consider the gain is coming. Suppose you have given a loan, personal loan today only. This is the month end is coming. He hasn't paid single rupee, but you consider the EMI is 7820. Let us example. In that 7880, the 5000 may be principal and 2820 may be considered. He hasn't paid a single rupee, but you consider this 2820 is coming. Got it? So before coming the revenue, means before getting the revenue, you consider revenue will be come. That is nothing but accrual system of accounting. Okay. Next, they attract capital charge and credit risk. Actually, what are the items are in banking book are attract capital charge, credit risk. There are some capital charge and credit risk, capital charge and market risk, and operation risk. I will explain in later videos. But these banking book will comes under credit risk. What? Understand? But trading portfolio. This is nothing but what? This is nothing but the trading book. It includes assets that are marketable. It has the following characters. These are the marketable instruments. In the previous one, these are not marketable instruments. These are assets and liabilities, which usually in the banking, the branch banking, these assets and liabilities we can see. But in the trading portfolio, these are the marketable instruments like promissory note, that is CP, certificate of deposits. We all know these are marketable instruments. Okay, this is not held until maturity. We all know if you are everybody will have the shares and mutual funds. So is there anyone who is keeping his shares until the maturity? No, right? Nobody. Today, whenever the rate is high, we are going to sell it. So these are not held until maturity. And mark to market system. These are all under market system only. The difference between book value and market value is nothing but a profit. Got it. You are purchased one share at 20 rupees, that is book value, and you sell it at a 50 rupees, that is the market value. The 30 rupees is your profit. Got it. The trading book nothing but what? Trade instruments. Bank book nothing but what? Banking instruments. Simple. And the last one is off balance sheet exposure. Off balance sheet nothing but contingent liabilities. You can you you may see these contingent liabilities in the balance sheet, that is footnote. I have in my earlier video explained that one. These are all contingent in nature, nothing but what? Bank issues guarantees and letter of credits and backup credit lines. This bank usually issues the guarantees for the fee based income, right? Fee based income. But if something happen, bank is the guarantor between the government or between the party and the customer. If the customer doesn't pay that, or if the customer doesn't fulfill that contract between the government or customer, what happen? Bank is the liable and bank has to pay that amount. So this is also associated with the risk, right? Because if customer doesn't pay the suppose there is a food processing contract is there. If a customer has came to your bank and wants a BZ of around 1 crore rupees, that 1 crore worth of food, 1 crore worth of rice is going to purchase from the government, right? He doesn't purchase and he doesn't hand over that 1 crore worth of rice to the government. What will happen? Government will give a notice to us, he has to pay that 1 crore rupees. That is the contingent liability for the bank. Yeah, this is also risk. Got it? So we have explained that three concepts, that is banking book, trading book, and off balance sheet exposure. This is important, right? Now the types of banking risk. This is important. This is the fundamental for the risk management. If you understand these risks, what are these associated risks, the types of risk? Not every risk is important. Some are much more important. Some are you can neglect. If you understand these type of risks and what are these risks, well, then the whole risk management is yours. Got it? We'll start with the liquidity risk. The heads of risk, you just notice it. You can take screenshot also. Liquidity risk, interest rate risk, market risk, default risk, operational risk, other risks. Okay, liquidity risk, this is important. Interest rate risk, this is also important. Default risk and market risk, operational, this is the priority. Other risks you can neglect, that is not important for the point of examination. Got it? Now see, what is liquidity risk? Liquidity risk nothing but, what is this liquidity risk? Liquidity nothing but what? Funding of long-term assets by a short-term liabilities. This is mainly arises because of funding of long-term assets by short-term liabilities. Liquidity means a liquidity crunch. How liquidity crunch will happen? We all know in the balance sheet there will be a long-term resources, also a long-term assets, also a short-term resources, short-term liabilities. Though the business person who has to invest the short-term resources to the short-term liabilities and long-term resources to long-term assets only. If there is any crisscross between these two, definitely there will be liquidity crunch will be happen. This is also called fund diversion. And we usually read it in newspaper. The fund diversion happen in the so and so firm. This is nothing but what? They will use the short-term resources to long-term assets or long-term resources to short-term liabilities. Got it? The same thing will happen with the liquidity risk also. Arises mainly from funding of long-term assets by short-term liabilities. Okay. The types of liquidity risk. There are the three types: funding risk, time risk, call risk. This is the three types under the liquidity risk. The funding risk is mainly arises due to unanticipated withdrawals. Got it? If there is a bank, suddenly everybody is coming to withdraw their deposit. What will happen? Suddenly liquidity crisis will be happen. That is called unanticipated withdrawal, causes to funding risk. And the time risk meaning but what? Need to compensate for non-receipt of expected inflow of funds. Suppose the bank has given one loan and he has to pay 3000 rupees as an EMI. Or leave it, I will give one more example. The bank has given loan of rupees 1 lakh, that is just say it is a credit card or crop loan. He has to pay 1 lakh. With that 1 lakh, the bank is going to give a amount to the deposit holder who also put the 1 lakh deposit at that bank only. What will happen if he doesn't pay this amount, that 1 lakh? The bank is not going to pay this 1 lakh also. Usually that won't happen, but I'm giving one example. So the need to compensate for non-receipt of expected inflows. If he hasn't paid this 1 lakh rupees, his bank is not giving to 1 lakh to the deposit holder. No, the bank is to be compensated that non-receipt of expected inflow. So this is called what? Time risk. Got it? And call risk. What is call risk? Crystallization of contingent liability. Crystallization of contingent liability means, I already told that contingent liability, that is the guarantees, LCs. If there is any invoking is there, then the call risk will be arises, since customers are not meeting commitment. See, this is what I am telling. Customer is not meeting their commitment, then bank is the liable. Got it? So these are the three types of risk under liquid risk: one, funding, time, call risk. And now interest rate risk. This is one of the important risks. And in the interest rate risk, there are gap or mismatch risk, basis risk, embedded option risk, reinvestment risk, net interest position risk. All these are very important. You may encounter with some problem with this kind of risk, right? First one, what is actually interest rate risk? Nothing but there is any interest rate differentiation between assets and liabilities causes the interest rate risk. Nothing else. The mismatch between interest rates for assets and interest rate for the liabilities. Got it? The first one, gap or mismatch. What is gap? Arises from holding assets and liabilities with different principal amount and maturity amount and dates. Suppose you have given one deposit for 6% fixed interest rate for 1 year. With that fund, you have given a loan around EBLR plus 2% float rate, and 2 years you have given that loan. Here bank is going to pay 6% FD, that is fixed amount. Here the bank is getting EBLR plus 2%, and that also for 2 years. The bank is committed for 1 year. With that amount, bank is given for 2 years. Okay. If there is anything between these two parties, because this party hasn't paid well, then the risk associated with the bank only, because there is a mismatch. Or if suddenly interest rate collapsed, and because this is market related, right? Interest rate collapsed, then what will happen? The risk is at the bank, because bank has to bear the expenses. Got it? This is nothing but this arises because of what? Holding of assets and liabilities with different principal amount, maturity amount and dates. And basis risk. The similar also basis risk also. Interest rates of different assets and liabilities may change in different magnitude. The same example I have taken here. The bank is given FD 6% for 2 years. With that amount, bank has given one vehicle loan with link to RLLR plus 4%, means 8% in interest rate. Out of that, RLLR is 4% and spread rate is 4%. Spread rate is 4%, right? I will write here. If RLLR going to be down, suddenly it become 2%. What will happen? The bank is charging 6%, and also bank is charging 6% for interest rate. Where will be the profit? There will be no profit. Okay, if again it down to 1%, it won't happen. But if it happen, the RLR become 1%, then what will happen? Because bank has a contract of 6%, it cannot be changed. But RLLR is changing, right? So bank is going to be loss. This is the basis risk. It's nothing but different assets and liabilities may change in different magnitude. Okay, different magnitude. Got it? Next, Embedded option risk, this usually several people usually hear about this risk, embedded option risk. What is embedded option risk? Changes in market interest rate, it causes to prepayment of credit card, demand bills, CCOD. Suppose all the loans and advances nowadays are linked to EBLR or RLLR, something market related lending rate. Got it? Suddenly the market lending rate comes down, then what will happen? Or suddenly it is going to be high. There is an employee, government employee, consider it is a state government or central government employee. He has taken a vehicle loan. For the time of taking a vehicle loan, the rate is around RLLR plus 4% in the first example only. 4% plus 4%. She got it for 8%, right? Suddenly this RLR become 8%. Now for 12% is going to be charged for that customer. So he thinks that he will get the big loss. Then suddenly he closes that loan. Okay. If he suddenly premature or prepayment of CC, is it profit or loss to the bank? Is definitely loss. So embedded option risk is that, but by the change of interest rate, there will be some prepayment of advances. This is going to be a loss to the bank. This is the risk. This risk is known as embedded option risk. Got it? Now reinvestment risk. Suppose there is an FD in your bank. One person, a familiar customer, he is putting FD for every year. Now you are giving for 7.25% for 1 year, right? Suddenly the other competitive institutions are going to offer for 8%. This FD maturity is within 2 days. You will hold for 2 days. After 2 days, he may close this FD and going for other organization. That is nothing but this FD is again not reinvesting at your bank. It is going to other banks. That is nothing but reinvestment risk. The all happen why? Because of the interest rate margin changes with our organization to other organization. And the last one is net interest position risk. Net interest position risk. Okay. Net interest position risk. In this case, what will happen? Assets is greater than liabilities. Assets is greater than liabilities. What will happen? Suppose a branch is having 20 crores of liabilities and having only 5 crores of assets. Is it good thing? Not at all good thing. For its branch, okay, because the extra amount will be given by other branches. That is no issue. Suppose if any financial organization which is having high assets and which is having high liabilities and low assets, this causes what? This causes net interest income. This affects the net interest income. If net interest income is down, what will happen? It is the big loss to the bank or financial institution. Okay. Now about the market risk. This is the most complex one in terms of numericals. If you consider the numericals related to market risk, bit complex one comparatively other risks. Quite complex one comparatively other risk, because it is a high complex numericals will be there in the subject. Those are also important from the prospect of examination also. Okay. Now, what is market risk? The name itself is a risk associated with the market, arises due to the adverse deviations of market. Okay. Also known as the price risk. That is important. It may comes in examinations also. The first one is forex risk, also known as exchange risk. What will happen? Adverse exchange rates movements during the period. Got it? If there is an exchange rates volatility is there, then definitely it will impact the forex business of that bank. That is known as forex risk, or also known as exchange risk. Got it? Next, default risk or credit. Listen, I am not explaining every risk here, because those are important in prospect of examinations or in prospect of subject that I am explaining here. Some risks I have left it. Suppose if we taken the market risk, I ignore the market liquid risk. Also in the type of interest rate risk, I ignore the yield curve risk. because these are not much important for the prospect of examinations. So that I skipped those chapters. Okay, now market risk is over. Market risk, the only thing is forex risk, that is also known as exchange risk. Market risk is known as a price risk associated with the adverse situations in the market. Got it? The most important one, and everybody knows the risk, is credit risk. Generally, usually we seen in the branches credit risk, that is nothing but NPA. Got it? The two types: counterparty risk, country risk. Counterparty risk is nothing but the borrower or the committed party is not obliged to pay and not in a position to pay, nothing but counterparty risk. Variant of credit risk associated related to non-performance. This is nothing but NPA. Everybody knows. And country risk, this is one of the important. Country risk, nothing but you have a given one LC or some type of shipment finance to the person who is in Japan. Okay, or so whatever country. In the India, you have given the loan to the person who is in Japan. He may be Indian, but he is settled in Japan. He is ready to pay the amount, but this country has put some restrictions for the Japanese or the person who is residing in the Japan. Okay, they have put some restrictions about the foreign exchange or change of foreign exchange reserves, so that this person is unable to pay the amount. This causes country risk. Means what? Type of credit where non-performance or counterpart arises due to constraints or restrictions imposed by a country is nothing but country risk. Got it? Next one is operational risk, is man-made risk, simple known as man-made risk. Means human mistakes leads to operational risk. What risk of resulting from non-adherence of internal policies and guidelines, that is. So everybody will usually do whatever what the staff who is performing. Generally, these risks associated with the staff or employees only, because the person who is not adhering the internal policies causes the operational risk. Good. And what are the types of operational risk? Compliance risk, strategic risk, reputational risk. This is the most important thing. Compliance risk, nothing but what? Suppose what's the happening? There will be some set of guidelines for every product, a set of guidelines for every operation. If he hasn't performed those guidelines, what will happen? Some may file a case, or some person may file a complaint on you. This causes what? This causes reputational risk also. Got it? Failure to comply with the regulations, code of conduct is called compliance risk. Strategic risk, nothing but what? Due to adverse business decision, means wrong decision has taken. If some person who is in the high level has taken the wrong decision, it will impact the whole business. That is nothing but a strategic risk. Why happen? The person who has taken the decision is wrong, and due to that person the risk has happened. Got it? That is strategic risk. And reputational risk. Reputation, nothing but what? The negative talk, a negative propaganda among the people happen. That causes reputational risk. Everybody know. So in the summary, what we have learned about this, the definition of the risk, and what is the linkage between risk, return and capital, that we have learned. And what usually banks, what are the activities of banking which is associated with this, that we have learned. And types of risks, what are the types of risks we have learned. In the next chapter, there is very much important class is there in the next chapter, that is risk identification, risk measurement, risk pricing, risk monitoring, risk mitigation. This is the important one. You may get the number of questions from this chapter. This is much more important. If you want to understand these chapters, you must understand what is the interest risk, what is market risk, what is embedded option risk. So these kind of concepts and these kind of terminals you must understand first. Got it? So that case I made this video. Okay, just take a screenshot for some of the figures I have mentioned in this video and concentrate on this next chapter also. This will give you the better understanding and will give the better marks in the examination also. If you like my content, please like, share, comment, subscribe to my channel, that is FinBank Academy. Thank you all.